Good morning. Today is Thursday, April 14th, one day before the dreaded tax deadline day. I'm Joe Terril, president of Terril & Company, private wealth managers in St. Louis, Missouri. And this is another video update on our thoughts on the economy and markets for our clients as well as associates and other people that follow our comments. The inflation news that we've talked about in the last 5 videos at least is real. This week, inflation at the consumer level was measured at 8.5%. Inflation at the wholesale level measured at 10.5%. This is not something that's getting ready to go away quickly. Investment markets, whether it's the bond market or the stock market, and even to a certain extent commodity markets, are holding on to the belief that this high inflation is going to disappear in the next 12 months. The refrain that you hear from some of the investment analysts is, we've reached peak inflation. From here on out, inflation is going to be going down. And some people think it's going back down to the 2% level that the Federal Reserve Bank wants it at. We completely disagree with this. And if inflation comes down, it'll come down more likely to the 5 or 6% range, which is still way too high and can ultimately cause major problems in the economy. So we are staying as defensive as we can be. We're holding our positions in energy, in gold, in companies that we believe are inflation stocks. Our fixed income holdings, we're staying as short as possible. We're able now to buy 1-year paper at a 3% level. That's about 2.75% more than you could get 6 to 9 months ago. However, we think interest rates are going to have to go higher than what the markets and a lot of analysts expect. And certainly we think there's going to continue to be a readjustment in most stock prices to a lower level. As companies generate cash flow and earnings and dividends, you put a value on those cash flows predicated upon what's the current level of interest rates. When interest rates were at 0, it calls for one level to be put on valuations. But as interest rates go up, the future value of those cash flows is not as high, therefore prices come down. We continue to believe that the average stock price between now and the end of the year is going to go down another 10 or 15%. In the first quarter of 2022, prices were down anywhere from 4.5% to 8%, depending upon what stocks you were in, but for the most part, they were all down. Bonds and fixed income were down 6.5% range. We really believe that trend is going to continue throughout the year. There are people that think as soon as the supply chain can be repaired and we have ample supplies of products, we'll see inflation come way back down to that 2% level. Disruptions in the supply chain have nothing to do with the inflation we're seeing. The inflation we're seeing is due to a 42% increase in M2 money supply. Said in simple English, the inflation we're seeing is because the Federal Reserve Bank in the United States and central bankers around the world for the last 10 years have printed way, way too much new money with no productivity behind it, and consequently currencies around the world are buying less than what they used to. If your currency buys less, prices of everything you're buying move higher. So the concept that some people have of why they believe inflation is getting ready to come back down, and therefore even some analysts are saying within a year and a half the Fed will probably be back to cutting interest rates. Sorry, but we believe any talk like that is ludicrous. We think interest rates are going to continue to go up, go higher than what most people think, and markets are going to continue to go lower. The economy around the world is going to do just fine. Some people think we're going to go into a recession. There's no indication of that yet. Consumers are out spending around the world. People are reopening the world economy after COVID by exercising pent-up demand for all types of goods and services. We believe that is going to continue. We think consumers all over the world are going to be out and spending. The question is, the labor markets are very tight, so people are working. If it's a two adult household, both people in the house have jobs, they're getting pay raises, and they know that, or feel at least, that their job is secure because there's such pent-up demand for workers right now. So they seem to be willing to get out and spend and not worried yet about the higher prices they're being forced to pay for anything. As this year goes on, we're going to be closely monitoring anything to do with that to see, is there a point where prices go too high and consumers decide, I just won't pay that price and I'm going to retreat on my spending. We don't know what's going to happen there yet, but that'll be the key. Until that happens with consumers, we're going to have a very strong economy. So I had someone suggest to me that, well, if you have a real strong economy, then investment prices have to do really well. No, that's not necessarily true. Corporate earnings and the increases we've seen in corporate earnings in the last 10 years are not guaranteed. If a company is experiencing higher labor cost, higher cost for energy, higher cost for everything they're doing, there's no guarantee that corporate profits are going to be maintained. Certainly, you can see corporate profits flat. So a strong economy is not a guarantee investment prices will do just fine or even go higher. We continue to advocate, and that's how we have our portfolios structured, that bond prices are going to continue to go down as interest rates go up, and most stock prices are going to continue to go down as those interest rates and inflation go higher. We remain cautiously bullish on commodity prices that have benefited us. Most of our portfolios in the first quarter of 2022 showed gains somewhere between 4%, 5%, 6%. We had those gains while everyone else had losses because we are invested in the commodity stocks and we're invested in basically what comes to interest rates moving higher. So we'll see how this plays out as we head towards summer. And thank you, Brian Curtis, for producing this video. And we will be back maybe the first week of May with another video update. Thank you for tuning in.